This is the CRE Weekly Digest by Lightbox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Melissa Lewis with our experts Manus, Clancy, and Dianne Crocker. Let's dive right in. We're now in week 5 of the conflict with Iran, and so far, CRE hasn't shown much of an impact, but the pressure is building. Risk premiums are widening, oil prices are spiking, and recession warnings are getting louder. And yet, we're seeing some surprises too. Consumer confidence came in stronger than expected, retail sales jumped, and Treasury yields have pulled back slightly. So what's really going on beneath the surface? Manus, kick us off.
Well, I think you summed it up terrifically, Alyssa. I do think that as we came to the end of March, it's been a very, very volatile period, that the war in Iran has really sent everything haywire. We've seen oil prices shoot up to as much as $120 a barrel. Last night was President Trump's speech to the nation, during which time he noted that this may go on for a couple more weeks. This morning, Thursday morning, we're seeing U.S. stocks down and oil prices up 10%. But that really set the tone for the entire month. We saw the S&P 500 approach correction territory, down almost 10%. Bond yields spiked, getting as high as about 4.45% for the 10-year. Risk premiums blew out. The cost of capital for CMBS and CRE borrowers jumped almost 100 basis points. So all of that took place with a backdrop of people being concerned already before the war about problems in the PE market. So March was about as volatile as it gets. We saw some really severe sell-offs. We're seeing another one today in early April. Yet when we got to the end of the month, there were some surprises. You referred to consumer confidence. That was shocking to me. Consumer confidence was 4 points above expectations. And the big thing behind that was that people felt better about the job market. That if something seems haywire, that seems to be it, right? We've seen months and months of anemic job growth. We've seen layoff announcements. We've seen people concerned about AI leading to more job cuts in the future. And yet somehow the most recent consumer confidence numbers says people are feeling better about this. Something doesn't square up there. We did see a huge equity rally in the last 2 days of March as people thought the war in Iran was winding down. We saw bond yields come back sharply down to 430 on the 10-year late in March. But the speech last night by the president kind of set us back a couple of weeks. I think the bottom line is this, that we will return to a point of normalcy. This war won't last forever. But right now, there's no telling if it lasts a couple of days or a couple of months. And until it ends, I do think that we live in this world of volatility.
Yeah, I mean, you nailed it, Manus, when you said that it's, it's as volatile as it's going to get. You and I both wrote market commentary on isolation yesterday, but we built both of ours around a similar theme. That phrase that March comes in like a lion and goes out like a lamb. And I said that March came in with an exclamation point and went out like a question mark. And one thing that really jumped out at me from the headlines this week is the chatter about recession, and that the recession conversation it's getting a lot more real. So Mark Zandi, the chief economist at Moody's, was one that came out and said that in all the years, I think it was 36 years of being an economist, he's never been this unsure about the economic outlook, not during Y2K, not during the great financial crisis, not even during the pandemic. So for any of our listeners who are out there scratching their heads, wondering where this is leading, you're not alone. And Zandi's point was that if conditions don't improve over the next month or so, that we could be heading into a recession. But, so I started thinking, Manus, about like what things would have to happen for a recession to really take shape. And it started giving me these memories back to like economic history classes I took in early years of college, and I remember we had this one professor who said this over and over, that since World War II, nearly every U.S. recession has had an energy shock in the background. And certainly we have that here. So for a recession to happen, we'd have to have a scenario where we had everything all at once, kind of like that Oscars winning movie a few years ago with Jamie Lee Curtis. We would have to have high oil prices that don't come back down, stress in the credit market that spills over, which you and I have talked about, consumers starting to pull back, which the report this week did not show, a labor market that weakens more quickly than expected. So there's rarely one single trigger. I think we'd have to have that kind of everything all at once moment. But the wild card, as you said, is how long does the conflict last? How long do oil prices stay high or go even higher? So a lot of question marks out there for sure.
Well, I would say a couple of things. You already talked about the head-scratching consumer confidence number, but you referred to it, that retail sales number also surprised everyone a couple days ago, that retail sales were as strong as they were. And again, it's really a conflicting view. You would think that with higher oil prices now for a month, higher gasoline prices, the threat of inflation looming over us, all of that would have led to people pulling back, and yet we haven't seen that yet. I do believe, and I believe this with all my heart, that this won't go on for months, this war in Iran, that the White House is sensitive to not putting troops in harm's way, and certainly not for long periods of time. I do think the president keeps an eye on the equity markets. I think he measures his own success by whether stocks are up or down. So I do think that if this started looking like a quagmire and we were looking at months and months of higher oil prices, he would likely call an end to this. So it comes back to my commentary that I posted, and you referred to the fact that we both do this weekly. It's only a matter of when, to me. And I do think the when happens, I do believe it's a very powerful rally for equities. And I do think we see oil prices collapse. I think we see interest rates come back to where they were in February. And I do think that the CRE market just takes off. We see people start locking in lower rates. Transaction activity starts to surge. All the things that we thought would happen in January and February start to happen, but they only happen once the war ends.
Agreed. And I want to just lean in on something that you said earlier, Manus, about the consumer spending report, which agreed, it really did run against the narrative, right? It seems like a disconnect given the headlines about the recession and higher oil prices. But I think an important nuance is just pointing out that we are in this K-shaped economy. So that means the top 20% of earners are driving 60% of total spending. So historical perspective, in the 90s, that was closer to 50-50. So when I see a headline that consumer spending is holding up, you look behind the details, and usually it means that the higher income consumers are shopping, but the lower households could be feeling the pressure, especially if they're paying gas prices at the pump, that are $7, $8 when they were $4 or $5 just a couple weeks ago. So, and I think that shows up in the deals that we're talking about week after week too. We've had a number of transactions that we've talked about on this podcast where investors are leaning in hard at the higher end retail developments. That's a function of this K-shaped recovery that we're in. And selfishly, I just want to hear you say K-ER again. So I wanted to bring that up.
K-ER. That never really took off. I like that expression too, but maybe because it's so hard to say that it has kind of languished. But I would say that what you just mentioned is not a healthy statistic, that so much of the spending is driven at the high end. It's not terribly surprising when you consider even before the war, we were talking about a K-shaped economy. And as prices rise, it will even get steeper at the upper end and at the lower end. So we'd like that to change. We'd like that to become more evenly distributed for the health of the country, and hopefully it does. I will bring up one more piece of data that we saw this week, and this came from Dianne of CNBC, puts out a report every week called The Property Play every Tuesday. It's a terrific read. You should read it. This week, she referenced a report from Apartment List, which has been tracking rents around the U.S. since 2017. And their report said that the March numbers showed the biggest decline in multifamily rents since they founded the index in 2017. So the biggest drop in 9 years. And there's two elements to this. For those at the lower end of the K, that's positive news, right? If your housing costs are dropping, that's a positive. But for the business that we operate in the commercial real estate markets, not a very positive sign. I think, I don't want to speak for you, Dianne, but I think we thought 6 months ago that the glut of building that took place in 2022 and 2023, that inventory was close to being absorbed, that we were close to turning the corner, that rents were going to start going up. This throws a little cold water on that thesis, and it's something we need to watch going forward.
Yes, Manus. I think that apartment list headline definitely grabs attention, but I think the story's a bit more nuanced. Yes, we're seeing this rebalancing between supply and demand. In some areas, especially in the Sun Belt, they've seen this wave of new units hit just as renters are starting to feel pretty stretched from higher costs. So the demand is still there. It just hasn't kept up with supply, which is leading to the softer rents that you just cited. But I just think it's important to note how differentiated apartment markets are. Some are still holding up well, others are working through oversupply. So while I agree that softening rents are something to watch, I think it's important to keep in mind that these are broad averages. And at the end of the day, there are some pretty significant differences market by market and metro by metro and even asset by asset.
Okay, Dianne, let's turn to our Lightbox data dive. What's the early word on the CRE activity index?
Well, we're in the first few days of the first quarter. March ended on Tuesday, so I am eagerly awaiting our next read on the CRE activity index. And yesterday I got 2 of the 3 pieces that I'll share here. So the first is on the environmental front. These are phase 1 environmental site assessment volumes. And those in March were up by 8%, and they were up 6% year over year. And the second is the degree to which property listings are coming onto the market. March's volume ran even with February's daily average, and it was 9% above January, a solid 25% year over year. So Manus, on the heels of everything that we just talked about and the enormous amount of volatility in the broader market, our data for March is showing that this is not a market that's sitting on its hands or retreating to the sidelines waiting for clarity. Based on these first 2 points behind the CRE activity index, they're both pointing up. And when I get the third one, we'll see where the whole index lands, and we'll have that number next week.
Well, as you know, and as our listeners know, once a deal starts working through the process and it has gotten far along, it is hard to pull the rug out from under the lenders and the buyers and the sellers. So my guess is that at least the early March stuff was probably stuff that was fully baked in February. I think it's really encouraging that these numbers are up, and it's a great positive. We're going to get to, in a moment, several new development stories, which will underscore what you just said, which is people are just kind of stiff-arming this aside for right now. But I do think that until we see the April numbers, the story is only half written. I do think that the headlines we're seeing are positive. People are still lending. We are seeing people developing. We haven't seen headlines about people retrading loans or walking away from deals. But I would say that at least for the first half of March, and maybe for the first 3 or 4 weeks of March, a lot of that was stuff that was baked. April will be a very important number. We'll have to see if this had any impact on velocity next month. I will point out that Bloomberg was reporting this week that one CMBS deal was pulled because of volatility. This was a single borrower deal. I think it was Brookfield borrowing on 2 malls, one in Houston, the Willowbrook, and one, I think, in California, the Altamont Mall as well. And the cost of funding went up so much that they said, let's wait and pull this deal for a couple of weeks until rates settle down. So that's really the only negative headline I've seen, other than the admission from many that the cost of funding right now is considerably higher than it was a month ago.
Mm-hmm. It's interesting too, Manus, because when I think back to last year, April, brought the start of the tariff wars, and we did see a little blip downward with the index in April, and then the market bounced. And so I wonder as we look forward if we'll see something similar this year, where maybe there's a little wobble in April and then the market gets back on track.
It wouldn't be shocking. I think that if we see a leveling off or a dip that lasts for as long as the war lasted, 2 to 4 weeks, something like that, we wouldn't be shocked. But all the evidence right now points to a market that if we see a dip, it's going to be very, very modest.
You're making our listeners feel a lot better.
That's what I'm here for.
Okay, time for our Did You Know for the week. Dianne, what do you have for us?
One of the things that jumped out at me, and this is from your team's data, Manus, on transactions that are closing. Just this week, they tracked 10 major deals that were all in the office space. And these 10 deals were $40 million and up. The largest was a $340 million sale in San Jose. The others were in LA, Chicago, Boston. There were 4 of the 10 were in Manhattan. And we'll talk about a few of these later, but it was a hot week for office, and it was a hot week for my Yukon Huskies, I have to say, who pulled it out in the last 2 seconds of the game on Sunday.
I was listening to that game on my Sirius XM radio in the car, and I almost couldn't believe it, what had happened. Duke is so poised normally, and they seem to close out games without a hiccup always. And to see them make that turnover with 5 seconds to go and UConn to hit the big shot, really a stunning turnaround.
It was. And your team, St. John's, played a fabulous game on Friday night. I was really pulling for them. They have some good players, some scrappy ones, and they played a great game.
I love my Red Storm. I have to say, I was down in the dumps for a couple hours after that game, but they're on the rise, and hopefully next year it'll be even better.
Yeah, good. These games are tough. It's like the agony and the ecstasy. They're all great or they wouldn't have made it that far, but one has to walk away a winner and the other call it a non-winner. I don't want to say
there we go. There you go.
Manus, let's jump into the deals that caught your attention this week, starting with development and lending.
I think our listeners will like this set of stories. They are evidence that now that we are, I guess, 33 days into the war in Iran, we're still seeing people put shovels in the ground, lending, and moving forward. So without further ado, let me get into these. The first one, Excel, who is a big ground-up developer, built some of the huge towers along Billionaires Row on Central Park South. They landed a $400 million loan for a 570 Fifth Avenue development. JP Morgan was the debt provider there. This is a little bit of a move into office. Like I said, Excel has done some really big high-end multifamily. This is office. The property will be anchored by law firm Simpson Thacher Bartlett. They will take 700,000 square feet of the project, which probably had a lot to do with the reason JP Morgan was so confident about lending on this. There'll also be a retail component, IKEA, in the ground floor that is already pre-filled. So Excel getting a loan for a shovels in the ground development. We like that one. In North Phoenix, Mac Real Estate and McCourt breaking ground on the $7 billion Halo Vista project. That's a mixed-use development in North Phoenix. $7 billion is nothing to sneeze at. You go forward with something like that, by definition, you are confident. JLL arranged an $88 million construction loan for a project in Shoreline, Washington. This is a multifamily project. Back to New York, BHI and Naftali lent over $200 million for a office to resi conversion near Times Square. Ioni Group plans a 32-story Midtown South building again in New York. They recently filed plans to bring that property on at 28 West 37th Street. And lastly, in Hudson Yards, again in New York, Konstantin Gubarev, the managing director of Prospect Development Group, he is planning to build a 34-story multifamily project on 10th Avenue. This would be the last undeveloped parcel in Hudson Yards. And again, a vote of confidence coming from lenders, developers at a time where confidence could easily erode, but we're seeing some really nice headlines. A lot of these headlines, by the way, coming from the Real Deal. I did not assign the individual writers to these. That's an oversight on my part, but in the future I will.
Yeah, that's great to see, Manus. A whole slew of development and lending headlines. Nothing, like you said, nothing says confidence like getting the cranes on site and getting the shovels in the ground. And you can't go wrong with IKEA as a ground level retailer, cheap furniture and a high rent apartment market. Perfect combo.
Okay, let's jump into the industrial deals that are making headlines. Manus?
Well, one really caught my eye. This is Blackstone paying $163 million for Broward warehouses. Why did this one catch my eye? Blackstone had been a big seller in South Florida last year. They moved about $1 billion worth of properties off their portfolio last year. We have seen some signs that the industrial market in South Florida was weakening a little bit, and Blackstone jumps in and pays $163 million for a new one. It'll be interesting to see if this is a one-off or a trend. The one-off would say, this is just an opportunistic buy, too cheap to ignore, let's go in and get it. If we see more of these, it's probably more likely that they say values have come down a little bit, the softening of the market is a buying opportunity, and they start redeploying money into this. It's also possible that they're just rotating, right, away from one type of industrial property into another. But that one sale alone really got my attention. I like that one a lot. Dianne, you have an industrial story to talk about as well.
I do. It caught my eye, and it takes us to a New England state, the great state of Maine. The Wall Street Journal's reporter, Will Parker, did an article this week that Maine is about to become the first state to pause new large data center development. They have legislation that's expected to pass that will halt any data center projects over 20 megawatts until late 2027. And the story says that Maine is likely just the first move, and at least 10 other states and multiple cities are considering similar restrictions. So in my mind, that signals a broader shift that takes a lot of the growing concerns we've been talking about here, concerns about data centers' access to power, data centers' impact on the environment. And for investors, it's, I think, a sign that this pushback from communities is translating into legislation that will limit the states where they can consider sites as strong candidates for data center development.
We really don't know where this takes us. To your point, we don't know who's bearing the costs, what the impact will be on the consumer. Will individuals in these areas be left holding the bag with higher energy prices across the board? And it makes you wonder, if that takes place, will we see another wave of demographic shifts, right? In Northern Virginia, things are already very expensive. If data center development, if they mess this up, right? If the bearer of the costs isn't Amazon or Microsoft or Google, if the bearer of the cost is the individual, does that lead to another wave of people either crossing the border saying, let's move to West Virginia or Maryland or Delaware, somewhere else where we're still in the region, but we're not being slammed with energy costs? Or does it push people to another wave of southern states, right down to the Carolinas or Florida? I think we just don't know. You hope that the people negotiating these deals on behalf of the utilities, on behalf of the municipalities, are smart. You know that often Google, Microsoft, Amazon have the smartest people in the room, but you hope that the people on the other side of the table are making sure that this is not destructive to their economies.
Yeah, exactly. And population migration shifts can be very impactful on commercial real estate. I mean, you only have to go back to COVID to see what happened after COVID, when a lot of folks moved to metros that they were thinking about moving to before the pandemic hit. And those have real impacts on commercial real estate. So if this continues, if at least 10 other states do the same, then yeah, we could see some material changes in population centers.
I do want to go back to industrial at large because it was, and you referred to the data collection team that assembles this data. It was a really, really good week for industrial in terms of high ticket sales. The biggest one, a $650 million purchase by Ares Management of a 36 property warehouse portfolio. The seller there, EQT. We saw in Oakland, California, WPT Capital paying over $110 million for a property on Pardee Drive. Glendale, Arizona, Prologis picking up the Cotton 303 Logistics Center. We can go on and on. Very diverse buyer group, very diverse seller group. So a lot going on in industrial. And as I've said before, that market is the rally that started in 2015 and never ended.
And kudos to your team. They're busy tracking all these new deals this week.
Excellent people.
Okay, Manus, we have time for one more. What's making headlines in office right now?
Well, Dianne referred to it a moment ago, just that office continues to sell in big numbers. The story there is similar to what we've seen for about a year. Office is selling at a very healthy pace. Things are changing hands. They just happen to be changing hands at prices that are fractions of what they had been selling for 10 years ago. And that really hasn't changed other than for the really high-end new product. So the big one this week, Bank of America Plaza in Los Angeles sold to Capital Group for $210 million. This property is a 1.4 million square foot office on South Hope Street. The sales price equates to $150 a square foot. But beyond the headline, this thing was valued at over $600 million a couple years ago. So it really represents about a 65% discount to where this thing traded in 2016. And that remains the narrative in office, that these properties continue to sell for well below where they were. We have another one here in New York, 40 West 25th Street. This is kind of in the Union Square, Bleecker Street area, a little bit north of that, I guess you would say. This property selling for $51 million to Kaufman Investments and Two Sigma. This property last sold in 2019, so not that long ago, for $121 million. This time selling for just $51 million. So it's of a piece. Office continues to trade, just not at the prices that excite anybody.
Yeah, and those are big numbers, especially with the Bank of America Tower. That I read was the 5th tallest building in the city, and it's got gold LEED certification. Plus, I saw a picture. It's a pretty plaza. It's got a fountain and eucalyptus trees in the middle. And it was interesting because the buyer was the building's anchor tenant. And they got this deal that, like you said, was at a price that was a fraction of what it went for 10 years ago. So that's the broader story. They're going to consolidate and bring more than 2,000 employees into this space. So there's a distress story that's creating new entry point in our downtown. And we're seeing that in not just in LA, but in metros across the US.
All right, before we close, let's wrap with our slice of life. April Fool's Day was Wednesday. Did you have any jokes played on you or any fake headlines that you fell for?
Well, I have to say that I am a perpetual huckster. I don't mind a good practical joke here and there. And I usually get a kick out of them as long as they're not dangerous, as long as they are just kind of funny and harmless. But I do hearken back to one that one of my children used to do, which I thought was mostly harmless. I didn't find out about it until long after they were doing it. Back in the day when everybody had the same cable system, now everybody has a different one and people have cut the cord, etc. One of my kids and his sidekick would sneak out of our house with our remote and run from backyard to backyard and change the TV stations of people watching television during the day and try not to get caught. So that was one that I bring up frequently. It wasn't just an April Fool's thing. It was whenever they can get away with it type of thing.
That's so funny. I love that. I do love playing tricks on my kids on April Fools. Anything that messes with their heads, like shifting their dresser drawers around or making their beds with the pillows at the wrong end. But I was reminded this week, Alyssa, of a corporate marketing prank. This was years ago that I always thought was clever. I'm left-handed, so any of our listeners who are southpaws know that we live in a right-handed world. Scissors, spiral notebooks, those one-piece school desks that always opened on the wrong side for me. But one of my all-time favorite April Fool's pranks, you'll love this, Manus. One year Burger King took out a full-page ad in USA Today to introduce a left-handed Whopper. And they claimed that they rotated all the condiments 180 degrees so that everything would skew to the left and not fall out the other side. And the best part was that people actually went into Burger King's asking for it. I didn't, but I thought it was really brilliant.
I love that. Completely harmless, and in that case, probably drove some business. When done well, it can be a fun day.
And with that, we'll close. Thank you to our producers at Bruning Media. Be sure to join us each week as we break down CRE news and data in context. You can listen on all your favorite podcast platforms and send your comments or questions to podcast@lightboxre.com. As always, thank you for listening and have a great weekend.
Let's go.